Yes, hello everybody. So we haven't had a podcast in quite some time, a couple of weeks I guess. But we're throwing this out there. It's for you to decide, for the listener to decide. Are we in an economic depression? Now we wrote a blog post about this, but we wanted to share it on as a podcast as well. It's a good question to be asking because there's so many parallels between what's going on in the economy today, 2016, verse from 1929 to the late 30s. So we're just going to go over a few things. Again, we're just asking the question, are we in an economic depression? And it's going to be something for you, the listener, to decide. So the parallels between the two are quite staggering, really. I'm just going to pick out a few things from our blog post. So the Obama administration, they used identical failed fiscal policies utilized by FDR during the Great Depression. $800 billion stimulus package, payroll tax holidays, student loans for anyone with the pulse, and hundreds of other useless Keynesian ideas have driven a national debt from $10 trillion in September of 2008 to $19.4 trillion 8 years later. That's a 94% increase in our national debt. In fact, it's probably going to be a hair over $20 trillion when Obama leaves office come January. The national debt in October of 1929 was $17 billion. 8 years into the Great Depression, after billions in wasteful New Deal programs, the national debt stood at $36.5 billion, a 115% increase. You can't deny that is an absolute parallel between the two. Let's see. Apologists for the status quo contend that the last 8 years couldn't possibly be classified as a depression. The narrative of economic recovery has been peddled by corporate media mouthpieces, politicians, too big to fail Wall Street banks, Federal Reserve puppets, and the government. They point to the lack of soup lines as proof we couldn't be experiencing a depression. Unfortunately, today the soup lines are electronic. As the government downloads the soup on EBT cards, so JP Morgan can reap billions in fees to run the SNAP programs. Just because there's no pictures of starving Americans in shabby clothes waiting for soup lines doesn't mean the majority of Americans aren't experiencing depression. There's 49 million people out of 305 million on food stamps. Okay? That's 15% of the people in this country are on food stamps. You've got another 45 million or so on disability. You've got who knows how many millions of people on welfare. You've got millions of people receiving checks for the government's, unemployment checks because they can't find work. These are all things that the media doesn't tell us, okay? If the country has actually been experiencing economic recovery for the last 7 years, why would 14 to 15% of all Americans be dependent on food stamps to survive? When the economy is actually growing, the unemployment is really below 5%. The percent of Americans on food stamps is below 8%, and that would be with an economy growing. But we're not. We have the American 14 to 15% of the American people on food stamps. The unemployment number they're telling us, 4.9%, that's all a bunch of hogwash as well. Let's see. If the government economic data was truthful, there would not be 43.5 million people dependent on food stamps. More than 100 million Americans are now dependent on some form of federal welfare. That's not including Social Security or Medicare. That's a third of the nation. Think about that. A third of the nation is getting a check or some type of benefit from the government because they can't make it on their own. A third of the country. And that's not including Medicare and Social Security. If the economy came out of a recession in the second half of 2009, like the government claims, why would 6 million more Americans need to go on welfare over the next 2 years? It's absolutely impossible. They're not telling us the truth. I'm just pointing out a few things from our blog post. You can check the whole blog post out. Let's see. If job growth was as strong as the government and corporate media proclaimed, how could weekly wages be growing at only 1.5% annually and averaging only 2% over the last 5 years? Again, it's statistically impossible. The true unemployment rate fluctuates between 15 and 25% during the 1930s. We had to stand in line for the relief checks and food. Isn't it weird that it isn't wired into bank accounts and downloaded onto EBT cards? Now, the unemployment number they're telling us is 4.95%. It's absolutely false. We're in that neighborhood of 15 to 25% is the real unemployment number. Let's see. As a matter of fact, let me go into that a little bit. The government approved unemployment rate, according to corporate mainstream media, is 4.9%. The U6 unemployment rate is the broadest unemployment measure, including short-term discouraged and other marginally attached workers, as well as those forced to work part-time because they can't find full-time jobs. Stands at 9.7%, almost double the mainstream media. And in fact, you could say the unemployment rate is even higher than 9.7%, somewhere upwards of 15%, because what happens is when people are no longer receiving unemployment benefits, the government automatically assumes that they're no longer looking for work because they can sustain themselves. The government is assuming maybe they inherited money from an aunt and uncle or whatever, or maybe the government is assuming they won a lottery. I have no idea what they're assuming. The point is they're no longer counting those people. They went through all their extensions of their unemployment benefits, and they've run out, but the government doesn't really care. So let's go. In the blog post it says, but if you want the true unemployment rate, you must adjust government figures for the misinformation which began in 1994. Long-term discouraged workers were defined out of official existence in 1994. If you stop looking for a job because there's no jobs available, the BLS pretends you no longer exist and you are dropped out of the unemployment calculation. John Williams of Shadow Stats rightfully adds these discouraged workers who are willing to work but can't find jobs. The real unemployment rate in this country has been between 18 and 23% for the last 7 years. Those rates are identical to the rates of the Great Depression. Just what I was saying about a minute and a half ago. The market fell 86%. The stock market fell 86% from 1929 highs to the 1932 lows. But even though the entire 1930s constitute the Great Depression, the stock market soared 260% from 1932 to 1937, making the current cycle bull seem puny in comparison. Did the 260% increase in the stock market over 5 years in the midst of the Great Depression benefit the average American in any way whatsoever? Absolutely not. They didn't own stocks. The 0.1% benefited as they benefited from the crony capitalism New Deal programs that poured money into their coffers. Fast forward 80 years to today, and you have the same dynamic. The only thing, there is a much bigger percentage of people that actually do own stocks, so it is helping them to a point. The 160% increase that we've seen in the stock market over the last 7 years has enriched Wall Street, billionaires, corporate chieftains, and the likes. The Federal Reserve, QE, and ZERP monetary policies, along with the Obama fiscal debt expansion, were solely designed to benefit Wall Street and not Main Street. Now, again, there are more people that do own stocks today that compared to 1929, the average American. It is helping them to a point, but they don't want to dip into that because that's for their retirement fund, right? How about the other? It's about 50% of Americans that own stocks, which is actually down, by the way, since before the financial crisis. How about the other 50% that don't own any stocks? Not helping them one iota. Again, we refer to the entire 1930s as the Great Depression, despite the fact that real GDP surged by 40% from 1933 and 1937. If today's mainstream media existed during the 1930s, they would be proclaiming the tremendous GDP growth and spectacular stock market gains. The real GDP in this country has grown by a pathetic 15.4% from the low in 2009. So again, the parallels are absolutely amazing. Total credit market debt to GDP peaked in 2010 at 381%, but 6 years later stands at 345% as the stagnant economy grinds to a halt. With the national debt of $19.4 trillion, 106% of GDP, poised to skyrocket by $1 trillion a year as entitlement programs on automatic pilot explode under the weight of baby boomers. Interest rates at historic lows and willfully ignorant populace and corrupt politicians unable and unwilling to address the debt crisis. The economy is poised in major trouble. Let's see. As the Fed talks, as they have everything under control, the actions and or inactions reveal an extreme level of desperation. As corporate profits soared to record highs and unemployment fell in 2007, the Federal Reserve discount rate should have been elevated to 4%. Instead, they keep it locked at emergency crisis levels of 0.25%. This proves that they're lying about the economic narrative. Absolutely. And we've been saying the Fed needs to normalize rates ASAP because when you have rates at the zero bound, it doesn't create the economic growth that theory said it was going to. And that's a major problem for the Fed, and they've painted themselves in a corner. And it's not just the Fed. It's all around the world. Let's see. I'm running out of time here, so I'm just kind of looking at some things. There are now more than 13 trillion of negative yielding government bonds floating around the planet. No one in their right mind would buy a negative yielding bond. It's not an asset, it's a liability. An investor is guaranteed to lose money on a negative yielding bond. You know the debt endgame approaches when government issues negative yielding debt. It's nothing but a stalling tactic to fend off the imminent collapse. Bill Gross, a relatively honest financial titan, contends Yellen and her contemporaries have taken reckless action. Bill Gross, by the way, is considered the bond king. I and others, however, have for several years now suggested that the primary problem lies with zero-bound negative interest rates, or zero-bound rates. That not only do they fail to provide an easing cushion should recession come knocking at the door, but they destroy capitalism business models. Those dependent on yield curve spread or interest rates that permit a legitimate return on savings as opposed to incentive on spending. Again, we have a major problem. We've unintended consequence of problems in the pension world. There's now $2 to $3 trillion underfunded pensions in the United States alone because they're bringing in only so much money, and they have to pay out a lot more. They can't get the rates of return with their conservative investing style, and they're paying out too much. So they're underfunded by $2 to $3 trillion. How about the elderly people that are retired and that they need to rely on those interest payments coming in? There's no interest payments coming in. It's done. So these are just some of the parallels between now and the Great Depression. It's up to you to decide if we're in it or if we're in a great economy. I'll leave that up to you. I hope you've enjoyed this episode, this question that we're asking, and we'll leave it up to you. Have a great day.